Imagine getting exposure to real estate deals without, needing that massive down payment.
Right, and skipping those late-night calls about leaky pipes.
Exactly. And completely avoiding the whole tenant situation, chasing rent, all that stress.
Yeah, traditionally, that kind of setup, it felt pretty much out of reach for most people.
Yes, sir. Real estate investing usually meant buying the whole property, needing huge capital, getting your hands dirty.
Or you needed serious connections, right?
Yeah.
Access to the big funds to get into those larger deals.
It definitely felt like an asset class, well, reserved for the wealthy or people ready to be full-time landlords.
But that whole landscape, how you access property investment, it's fundamentally shifted.
It really has.
Yeah.
Suddenly, people like you, maybe with smaller amounts to invest, can actually get into property deals just by pooling resources online.
We're talking fractional ownership here, or investing in loans backed by real estate, all through these online platforms.
It feels like a much more modern way in, doesn't it? Democratizing access to something that used to seem locked away.
It really is. And that's exactly what we're diving into today, real estate crowdfunding, specifically here in the U.S.
Okay, so at its core, it's this model where lots of individuals pool their money, usually online,
to fund specific real estate projects or buy properties together, essentially.
And our goal for this deep dive is to really unpack how this works, drawing from all the sources we've gathered.
Right. We'll look at the mechanics, the benefits, the potential benefits, and definitely the risks.
Which are significant, yeah. We'll also break down things like debt versus equity structures.
And touch on some of the main platforms operating in the U.S. market.
And we can't really talk about this without mentioning the regulatory side, particularly the JOBS Act of 2012. That was huge.
Absolute pivotal. It basically reshapes the whole environment for this kind of investing. Everything we cover comes straight from the research and notes provided.
Great. So let's start right at the beginning. What is real estate crowdfunding, fundamentally? How does pooling money online turn into an actual property investment?
Well, at its most basic, it really is just that. Pooling money from many individuals, almost always through these specialized online platforms.
Okay, so the platform is the key here.
It's the intermediary. It connects investors, people like you, with capital, with the folks who need funding for real estate projects, developers, property owners.
For all sorts of projects, right? Could be small, could be huge.
Exactly. Anything from renovating a single house to developing a massive commercial building or buying a whole portfolio of apartments.
So instead of a developer needing one giant check from an institution,
they can potentially raise the same amount by taking smaller slices from hundreds, maybe thousands of individual investors through the platform.
And for the investor putting in that smaller amount, what's the actual outcome? What do they get?
You gain some kind of interest in that underlying real estate. It could be fractional ownership, literally owning a tiny share of the property.
Like owning 0.01% of an office building.
Sort of, yeah. Or you might be investing in a loan that's secured by that property, so you're acting like a lender.
The key is you get exposure to real estate returns without buying the whole thing yourself. No management headaches.
That's the idea. You avoid the direct ownership burdens.
And these online platforms, they do more than just host a website, right? They're managing quite a bit behind the scenes.
Oh, absolutely. The platform is the engine. They're not just listing sites. Think of them as the crucial bridge.
So they find the deals first.
They source potential deals from developers or sponsors, yes. Then, importantly, they perform their own initial due diligence.
Vetting the deals before they even show them to investors.
Correct. They decide which ones make the cut to be presented. And, the quality of that vetting process can vary a lot between platforms. That's key.
Okay, so they curate the opportunities. What else?
They present all the information, project details, sponsor background, financial projections, risks. Then they handle the complex legal stuff needed to pool all that money, setting up LLCs, other entities.
That sounds complicated.
It is. And they manage ongoing admin, too, collecting funds, sending them to the sponsor, providing updates to investors, handling distributions.
Distributions being rental income, interest payments, profits from a sale.
Exactly. They handle getting that money back to the individual investors. They take on the heavy lifting administratively and legally.
Which is a huge part of the passive appeal, I imagine. You're not dealing with lawyers or property managers directly.
Precisely. The goal is more passive returns compared to direct ownership. Lets investors focus on picking opportunities, not managing assets.
This whole online model, it feels pretty new in the grand scheme of things. How did we get here? What allowed this to happen?
It's really a story of technology meeting regulation. Technology, the internet, the sophisticated platforms that provided the infrastructure.
The ability to reach millions, handle tons of small transactions.
Right, the scale and efficiency. But tech alone wasn't enough. It was the shift in the regulatory world that really opened the doors.
You mentioned democratization earlier, making deals accessible that used to be only for the big players. That came from regulatory changes.
Directly. Lowering the barriers to raising capital from a broader pool of people was key.
And in the U.S., the big moment was the Jumpstart, our Business Startups Act, the JOBS Act back in 2012.
Absolutely. That was transformative for private capital markets. Real estate crowdfunding platforms were huge beneficiaries.
Why was it so impactful? What did it change?
Before the JRBS Act, asking the general public for money for private deals was really restricted by securities laws. The act aimed to ease those rules to help startups and small businesses get funding.
And real estate fell under that umbrella.
Yes. Several parts of the act created the pathways these platforms use now.
Can you walk us through the key parts? Which titles mattered most?
Sure. First, there's Title II. This led to something called Rule 506C under Regulation D. Big change here. It allowed companies raising private money to use general solicitation and advertising.
Meaning they could actually market deals publicly, websites, emails.
Exactly. For the first time in ages. But there was a catch. Under 506C, they still had to make sure all the investors were accredited.
Accredited investors being those meeting certain income or net worth thresholds, right? The wealthier investors.
Correct. Generally, $200 pay income for an individual, $300 K jointly, or $1 million net worth, not counting your primary home. So Title II opened up advertising, but mainly to that accredited pool initially.
Okay, what came next?
Then came Title III, which set up regulation crowdfunding, or RED-CF. This was the real game changer for democratization.
How so?
RED-CF created a specific exemption allowing companies to raise money from non-accredited investors, everyday people.
Ah, so opening it up beyond the wealthy.
Yes, but with limits. Non-accredited investors had caps on how much they could invest over 12 months based on their income or net worth, and these deals had to go through SEC-registered online platforms or broker-dealers.
So investor protection limits were built in.
Right. It opened the door much wider, but with guardrails.
And there was a Title IV as well.
Yes. Title IV introduced Regulation A+R, sometimes called a mini IPO. This allowed companies to raise larger amounts up to $20 million under Tier 1, or up to $75 million under Tier 2, from both accredited and non-accredited investors.
$75 million, that's significant capital.
It is, but Reg A+ comes with more extensive public disclosure requirements than Reg CF or Reg D. Things like SEC filings, audited financials for Tier 2, ongoing reporting. It's a bigger undertaking for the company.
Okay, let me try to summarize. Title II, advertise deals, but only sell to accredited. Title III, Reg CF, sell to non-accredited to, with limits, through registered platforms. Title IV, Reg A+, raise larger amounts from everyone, but with more public disclosure.
That's a perfect summary. The key is, without the JOBS Act paving these pathways, the U.S. real estate crowdfunding market as we know it just wouldn't exist.
It legitimized it and provided the structure.
Exactly. That regulatory shift, combined with the tech platforms, is what brought this asset class to a much wider audience.
Okay, so now that we understand how it became possible, let's talk about why investors are drawn to it. What's the big appeal, according to the sources?
There are several key drivers. Things that really resonate with investors looking beyond just stocks and bonds or wanting real estate without the landlord job.
The first one seems obvious. Diversification.
Absolutely. Real estate historically doesn't always move in lockstep with the stock market. Its performance can be quite different.
So if stocks are down, real estate might hold up better, or vice versa, potentially smoothing out your overall portfolio returns.
That's the theory. It can potentially reduce overall risk, but crowdfunding adds another layer. It lets you diversify within real estate itself.
Ah, okay, so not just adding real estate to your portfolio, but spreading your real estate bets across different types of properties and places.
Precisely. Instead of putting, say, $200,000 into one rental house in your city, you could put maybe $5,000 into an apartment complex in Texas, $5,000 into an industrial warehouse fund, $5,000 into a medical office building on the East Coast.
And even different types of deals, like debt versus equity.
Exactly. Across property types, residential, commercial, industrially, across geographic locations, and across investment structures. That spread can cushion the blow if one specific investment doesn't pan out.
And doing that traditionally would require enormous amounts of capital, which leads right into the next big plus, Lower entry costs.
Absolutely critical. This is maybe the biggest draw for the average person, buying property directly. You need a huge down payment, closing costs, maybe renovation funds, often tens, if not hundreds of thousands of dollars.
Crowdfunding blows that barrier away, doesn't it? What kind of minimums are we talking about?
I mean, incredibly low based on the sources. Platforms like Fundrise or Ground Floor in the US have minimums as low as $10.
$10.
Seriously, $10. Arrived is around $100. Even looking across the pond, Estate Leroux in Europe is about €50.
Wow, that changes everything. Someone with just a few $100 can start getting exposure.
It's transformative accessibility. A much wider demographic can now participate in real estate investing in a way that was just impossible before.
Incredible. And once you're in, there's the promise of passive income.
Yes, that's the allure. Earning from real estate without being the landlord. If you invest in equity in a rental property, you get a share of the net rental income.
After expenses, management fees, etc.
Right. And if you invest in debt, you get regular interest payments, like earning yield on a loan.
And someone else is handling the tenants, the repairs, the leaky toilets we mentioned?
Correct. The platform, or more accurately, the project sponsor or the property manager, handles the operations. Your role as the investor is providing capital and receiving the distributions. Passively, ideally.
You also get access to a wider range of deals, right? Things you wouldn't find on Zillow.
Definitely. Platforms often feature deals you couldn't access individually. Large commercial projects, institutional-grade properties that usually trade between big funds, niche sectors like self-storage or senior housing.
And deals in places you don't live or have expertise in.
Exactly. Geographic diversification made easy.
And finally, the platforms often talk about transparency.
They do. They usually provide a lot of information up front. Financial models, business plans, market data, sponsor bios, risk disclosures, legal docs, and ongoing updates once you invest.
But the sources caution us here, don't they? Just because the info is there doesn't mean it's easy to understand or always reliable.
That's a crucial point. You have to scrutinize the depth and quality of that transparency. Read the fine print. Don't just take the headline numbers at face value. It requires critical thinking.
Okay, so the upsides are clear. Diversification, low entry, passive income potential, deal access, transparency claims. But let's pivot to the other side. The sources are very clear this isn't risk-free. What are the major risks investors absolutely need to understand?
This is maybe the most critical part. The upsides are attractive, but the risks are real, significant, and different from buying stocks.
And the one that comes up again and again is illiquidity.
Yes. This cannot be stressed enough. This is not like selling stocks where you click a button and get your cash in a couple of days.
Absolutely not. Real estate crowdfunding investments are generally highly illiquid. When you put your money in, assume it's locked up for the full term.
What kind of terms are we talking?
It varies. Shorter-term debt deals might be 6, 12, 18 months. But for equity deals, especially developments or stabilized rentals, you could be looking at 5, 7, 10 years, or even longer. 10 years. Wow. So what if life happens? Financial emergency, unexpected bill?
Yeah.
You need that money back sooner.
It's tough, very difficult, sometimes impossible. Some platforms might offer secondary markets where you could try to sell to another investor, or redemption programs where the platform might buy back shares.
Could? Those sound like weak guarantees.
Because they are. These options are not guaranteed. They often have restrictions, hefty fees, potential discounts on your value, and crucially, the platform can suspend them.
Especially if the market turns sour or the platform itself is struggling.
Exactly. The sources mention the CrowdStreet.eu secondary market closure in Europe as a real example. Liquidity options can vanish. You must only invest capital you are certain you won't need in the short or medium term.
That's a huge consideration.
Oh.
Okay, besides illiquidity, what about risks from the wider economy?
That's market risk. Like any real estate, these deals are vulnerable. Economic downturns, that can mean more vacancies, lower rents, falling property values.
Rising interest rates.
That can hike financing costs for developers, hurting project returns. It can also push down property valuations.
Well, local issues matter too, right?
Absolutely. Overbuilding in one city, a big employer leaving town, demographic shifts, any of those can hammer the performance of properties in that specific market.
Then there's the platform itself. The intermediary you're trusting.
Yes, platform risk. The risk that the platform you chose runs into trouble. Operational failures, bad management, even going bankrupt.
And if the platform fails, what happens to my investment? Even if the underlying building is doing fine.
It could get very messy. Complications in managing your investment, receiving payments, getting your capital back eventually. It adds a layer of risk you don't have with direct ownership.
The sources gave some sobering examples here. The Nightingale Properties issue on CrowdStreet.
Right, where the sponsor's CEO allegedly diverted investor funds. That led to investigations, platform changes. It highlights the sponsor risk, which platforms are supposed to mitigate.
And the CrowdState.eu shutdown you mentioned.
Attributed to tough market conditions and sustainability issues for the platform itself, these aren't just theoretical risks. They show why vetting the platform is as vital as vetting the deal.
That's a really important layer.
Okay.
Beyond the platform, the specific project carries its own risks too.
Of course, project default or failure risk. Risk tied to that individual property or development. The sponsor might mess up.
Like
Construction delays, costs ballooning beyond budget, failing to get permits, struggling to find tenants. If it's a flip, maybe they can't sell it for the expected price or timeline?
And any of those could lead to lower returns or even losing money.
Yes. It could mean missed payments on debt deals or partial or even total loss of your capital on equity deals if the project completely fails.
And navigating all this involves understanding complex structures and, of course, fees.
Which brings us to complexity and fees. The investment structures can be intricate. You might be in an LLC, a limited partnership, a REIT, some special fund structure.
Understanding the legalese and how it affects your rights and returns isn't always easy.
Not at all.
Yeah.
And the fees. Oh, the fees, they can be everywhere.
It's not just one simple management fee, is it?
Rarely. You could see platform fees, asset management fees to the sponsor, acquisition fees when buying, disposition fees when selling, loan origination fees, admin fees, withdrawal penalties if you try to exit early, secondary market fees.
Wow, that's a lot of potential deductions.
And the crucial thing is these fees stack up. They can seriously eat into your net return what you actually keep. A deal might advertise a juicy target return, but you have to dig into the documents to find all the fees and calculate your expected return after costs.
The headline number might be gross, not net.
Very often. You need to be diligent. And finally, there's regulatory uncertainty. While the JOBS Act and things like ECSPR in Europe provide frameworks, the industry is still young. Regulations could change, impacting platforms, structures, or taxes down the line.
That's a heavy list of risks. It really underscores that passive doesn't mean risk-free or effort-free.
Not even close. Understanding these risks, especially illiquidity, platform risk, project risk, is absolutely fundamental.
Let's dig into the investment structures a bit more. Debt versus equity. You touched on this, but what are the core differences and why do they matter so much?
Understanding debt versus equity is crucial because it defines your place in the pecking order, your potential reward, and your risk.
Okay, start with debt. What does that look like?
With debt, you're basically playing the role of a lender. You're loaning money to the real estate sponsor for their project, maybe acquisition, construction, renovation, bridging finance.
So I'm like a mini bank for that specific deal.
Pretty much. Your return is a fixed interest rate over a set time. You get regular interest payments, then your principal back at the end.
And it's secured, right, by the property.
Almost always, yes. That's key. If the borrower defaults or the project tanks, the debt holders get paid back first from selling the property's assets before the equity holders see a dime. You're higher up the capital stack.
Examples being loans for flips, construction loans.
Exactly. Short-term bridge loans, things like that.
Okay, and equity. How is that different?
With equity, you're buying an ownership slice. A piece of the property itself, usually through shares in an LLC or similar entity that owns the building, you become a part owner.
So my return isn't fixed?
Nope. It's tied directly to how well that property performs. Your returns come from two places. Your share of the net income, like rent after all expenses, paid out periodically.
And a potential appreciation. If the property value goes up when it's eventually sold or refinanced.
Precisely. If the property does really well, your upside potential is much higher than with a fixed-rate debt investment. Examples are investing in a rental property syndicate or funding a development for a cut of the profits.
Let's break down the pros and cons of each based on the sources. For debt, what are the upsides?
The pros for debt usually boil down to lower risk, relatively. Being secured and higher in the capital stack means a better chance of getting your principal back if things go wrong. It's generally seen as less risky than equity in the same deal. Predictable income. That fixed interest rate gives you a steady, predictable cash flow stream. Good for income seekers. Shorter holds, potentially. Many debt deals, especially for flips or bridge loans, have shorter terms, maybe 624 more compared to long-term equity holds.
Okay, less risky, predictable income, maybe shorter term. What are the downsides of debt?
The cons for debt include capped returns. Your upside is limited to that fixed interest rate. If the project is a home run and property values soar, you don't share in that extra profit. Lower potential returns. Because the upside is capped, the maximum potential return is generally lower than what a successful equity deal could generate. Prepayment risk. The borrower might repay the loan early, good for them maybe, but you get your principal back sooner than planned and miss out on future interest payments. Fees, potentially higher intact. While often paid by the borrower, origination or servicing fees can implicitly reduce your effective yield if not carefully analyzed.
Got it. Safer, predictable, capped upside. Now, equity. What are the advantages there?
For equity, the pros highlighted are uncapped returns. This is the big one. If the property hits it out of the park strong rents, big appreciation, your returns aren't limited. You participate fully in the upside. Potential tax benefits. As a part owner, you might get tax advantages like depreciation deductions, which can lower your taxable income from the property. Though tax rules are complex, fees structured differently, equity fees, asset management, promote exist, but might feel less like upfront costs compared to some debt fees, though the total impact still needs scrutiny.
And the risks or downsides of equity.
The cons for equity are significant. Higher risk. Returns depend entirely on performance, and equity is last in line to get paid in a downturn. You're first to lose capital if the project fails or values drop. Definitely riskier than debt. Longer hold periods. Equity investments, especially in stabilized properties or big developments, often require much longer commitments, 5, 7, 10+ years typically. Your money is tied up for a long time.
So equity offers higher potential rewards and some tax perks, but with significantly more risk and a much longer time commitment. It really forces you to match the structure to your own profile.
Absolutely critical. Need predictable income and shorter terms. Lean towards debt, seeking long-term growth, comfortable with more risk and illiquidity. Equity might fit. Many platforms offer both, or blended funds.
Speaking of platforms, the U.S. market is crowded and diverse. Investopedia looked at 19 platforms using dozens of criteria. It's definitely not one size fits all.
That's right. The platform choice is huge. They cater to different investors, different goals. Let's run through a few key examples from the sources to see the variety.
Sounds good. Let's start with Fundrise. It gets mentioned a lot. Best overall, beginners, low fees. Who's it for?
Fundrise is definitely aimed at the everyday investor, especially beginners or non-accredited folks. The standout. That $10 minimum investment makes it incredibly accessible, open to any U.S. resident.
And they focus on funds, not individual deals.
Primarily, yes. Proprietary funds, like their rates and E-funds. So you invest in a fund holding many properties, instant diversification across residential, industrial, often in the Sun Belt. You're not picking individual buildings.
How about fees and liquidity?
Fees are pretty clear and competitive for that access level, around 1% annually combined, advisory plus asset management. Liquidity. They offer quarterly redemptions, but, and this is crucial, it's not guaranteed, penalties apply, especially early on. Treat it as long-term.
So great for starting small, getting diversification easily, but still need that long-term mindset.
Exactly. Pros. Tiny minimum, non-accredited access, instant diversification, user-friendly, clear fees. Cons, liquidity, not guaranteed long holds, no control over specific assets, limited support options, less live education.
Okay, next, equity multiple. Tagged as best for accredited investors and transparency. Who are they targeting?
Equity multiple is squarely for accredited investors wanting institutional-grade commercial real estate, CRE. They offer diverse structures, short-term debt notes, Alpine Note 5K amends 3 to 9 months, income-focused debt funds, Ascent Income Fund 8-12% target, redemptions after 1, often 20K amends, that's sometimes $5 entry, and direct equity deals in specific properties, 10K, 30K plus minimums.
So more complex options for those who qualify and have more capital. Fees and liquidity.
Fees vary, typically BEM 0.5%, 1.5% annual AUM for equity plus others. Liquidity depends on the product. Short-term notes are more liquid. The Ascent Fund allows redemption requests after a year, but direct equity is generally illiquid for its multi-year term.
Right. So for accredited investors wanting various CRE options, comfortable with higher minimums than Fundrise.
That's the niche. Pros, diverse CRE access, institutional focus, relatively low $5K entry for some products for accredited platforms, good support, transparency claims. Cons, accredited only, higher minimum liquidity for direct deals, potentially fewer live deals due to strict vetting, no mobile app.
YieldStreet is noted for alternative investment selection. What's their story?
YieldStreet goes beyond just property. They offer real estate, yes, but also things like art finance, legal finance, crypto funds, transportation assets, a wider alternative universe. Minimum is usually $10,000.
Accessible to non-accredited investors.
Partially, which is interesting, their main YieldStreet alternative income fund is open to non-accredited investors, offering broad diversification across alternatives. But accessing their full menu of specific deals needs accredited status.
So, a platform for diversifying beyond traditional assets and just real estate.
Exactly. Fees depend on the investment, 0% to 2.5%. Hans noted. Availability varies. Some deals have very long lockups, up to 7 years. Need to verify accredited status for full access, not available in NDNE.
RealtyMogul focusing on commercial real estate.
Yes, RealtyMogul offers CR to both accredited and non-accredited investors via different routes. They have 2 public non-traded REITs, Income REIT, Apartment Growth REIT, with 5 co minimums open to non-accredited. For accredited folks, they offer private placements in CRE properties, multifamily, office, etc., but with higher minimums, $25K, $100K.
Their fees sound complicated.
The sources describe them as complex and variable. REITs have annual management fees, 1 to 1.25%, plus offering costs. Private deals have sponsor set fees. Liquidity is limited. REITs have a capped, non-guaranteed quarterly buyback program with discounts early on. Private deals are generally illiquid, 2 10-year holds.
So an option for non-accredited wanting REIT exposure to CR or accredited investors looking for direct deals with higher entry points and long holds.
That sums it up. Pros, non-accredited REIT access, both REITs and private deals offered claim rigorous vetting. Cons, high private deal minimums, complex fees, limited non-guaranteed REIT liquidity, long holds.
Now, Arrive sounds unique, best for rental properties. What's their model?
Arrived focuses on fractional equity ownership of individual single-family rentals and vacation homes. You buy shares in specific houses, aiming for passive rental income and appreciation without being a landlord. Minimum is low, just $100.
Accessible to everyone, like Fundrise.
Yes, both accredited and non-accredited U.S. investors. Fees include a quarterly AUM fee, 0.10, 0.30%, plus property expenses are passed through.
Individual homes.
Yeah.
How does liquidity work there? Sounds very long-term.
It is extremely long-term. This is the big catch. Expected holds for rental shares are 5-7 years. For vacation homes, up to 15 years. They have managed funds that might allow redemptions after 6 months, quarterly, subject to approval, so very limited and uncertain. The source is stress. Arrived is only for very patient long-term capital.
15 years, that's a serious commitment for a small investment.
It really is. Cons. Extreme illiquidity long hauls, relatively new company, email-only support, no Android app currently. Pros, very low minimum, non-accredited access, direct ownership in specific homes.
Lastly, DLP Capital. Best for real estate investment selection.
Yeah.
Sounds high-end.
Very much so. Opposite end from Arrive Fundrise, DLP caters only to high net worth accredited investors. Minimum investment. $200,000. They manage over $5 billion, offering diverse funds across different strategies, rentals, community development, lending, mortgages.
So definitely for a sophisticated, wealthy investor base.
Correct. Fee is 2% annual management, with rebates for $1 plus. Investments are generally illiquid private funds with multi-year commitments. Pros, wide fund selection, IRA options, curated portfolios. Cons, very high minimum, accredited only, potentially less upfront transparency on fund specifics, illiquid.
That really paints a picture of the diverse U.S. platform landscape, from $10 entry points to $200 minimums, funds to direct deals, debt to equity. The sources also briefly mentioned Europe. How does regulation differ there?
The European scene is largely shaped by ECSPR, the European Crowdfunding Service Providers Regulation. It aims to harmonize rules across the EU, allowing authorized platforms to operate cross-border with an EU passport.
And they have that key IS document, Key Investment Information Sheet.
Exactly. Mandatory for each offer under ECSPR. It's a standardized, short, max 6 pages, document outlining key info. Project owner, project details, risks, terms, fees, rights, remedies.
Designed for clarity and comparability.
That's the intent. Make it easier for investors to grasp the basics. But, and this is important, the KI is generally not pre-approved by regulators. Responsibility for accuracy lies with the project owner and platform. So investors still need to read it carefully.
It's not a regulatory stamp of approval on the deal itself.
Precisely. And the EU framework also distinguishes between sophisticated and non-sophisticated investors, giving the non-sophisticated extra protections.
Like what?
A knowledge test, a simulation of potential losses, and a 4-day reflection period to back out after committing, trying to add safeguards for less experienced investors.
And the brief examples, Estate Guru and Razors.
Just illustrating the variety there, too. Estate Guru, low 50 minimum, focuses on property-backed loans across many countries, has an active secondary market. Razors, higher 1K minimum, real estate bonds mainly in FRCHBLU, generally illiquid, shows different models operate under the same broad EU rules, just like in the US.
So whether US or Europe, the platform and project specifics matter immensely.
Yeah.
Given all this variety and the risks, especially illiquidity, how should someone approach due diligence? It seems crucial.
Absolutely critical. You can't just pick the highest return shown online. Effective due diligence involves 2 steps. First, assess yourself honestly. Second, rigorously assess the platform and the specific project.
Okay, step 1, assessing yourself. What does that mean?
Be clear on your goals: income, growth, diversification. Then gauge your real risk tolerance. Can you stomach potential losses? How much uncertainty are you okay with? And critically, assess your capital and time frame. How much can you invest, and for how long can you truly lock it up without needing it? Remember that illiquidity point. If you might need the cash in 3 years, many deals are off the table.
That self-awareness is foundational. Then, assessing the platform.
Turn the microscope on them. Research their reputation, history, who's the management team, their track record in real estate, finance, tech. Find info on past deal performance, good and bad. Dig into the entire fee structure. Understand the impact on your net return. Check your eligibility, accredited residents. Evaluate their deal flow quality. Does it match your goals? Understand their liquidity options, precisely terms, fees, reliability, suspension conditions.
And check their regulatory status, right?
Non-negotiable. SEC registration where needed, ECSPR authorization, check data security, assess customer support, educational resources. Remember the Nightingale CrowdStreet issue, understand their vetting process for sponsors.
Okay, and finally, assessing the project itself, especially if it's a direct deal or understanding a fund's strategy. The sources mentioned adapting the 5 T's.
Yes. It's a useful framework from venture capital, adapted for real estate, team, sponsor developer. Who is running this specific project? Their track record, similar project experience, financial stability, reputation. You're betting heavily on them. Nightingale is the cautionary tale here. Technology product, property deal. What's the actual asset, type, location, condition? Is the plan, build, fix, stabilize feasible? Is the valuation reasonable compared to the market, total addressable market, local market? What's the health of the specific location? Supply demand, vacancy rates, rent value trends, economic outlook. Is there real demand for this property here? Traction, project viability progress. Where is it at? Permits secured, pre-leasing, pre-sales, occupancy history. Are the financial projections realistic, conservative? Terms. Investment structure, the nitty-gritty, how's the return calculated, all the fees, exact hold period, exit plan, investor rights, what happens in default, for debt, what's the loan to value, LTV.
That 5 T's framework gives a solid checklist. It really drives home that passive income requires very active due diligence up front.
No shortcuts. You have to do the homework to invest responsibly here.
Another complex area, taxes. What's the general picture for real estate crowdfunding investors?
Taxes are definitely complex, highly dependent on your location, the property's location, the investment structure, LLC, REIT, debt, equity, the platform. Always consult qualified tax pro. But general U.S. points from the sources.
Okay, what are some highlights? Income tax, rental income or interest payments. Usually taxed as ordinary income. Capital gains tax, profit from selling the property or your equity stake. Taxed as capital gains. Potentially lower long-term rates if held over a year. Pass-through taxation. Many deals use LLCs partnerships. Income, losses, deductions flow through to your personal return via a K-1 form. Avoids corporate tax but adds complexity, potentially multi-state filings if properties are in different states. Depreciation. Equity owners often get this non-cash deduction for property wear and tear, not land. Reduces taxable income, but watch for recapture tax on sale. Deductible expenses. Platform fees, management fees, etc. might be deductible if not already netted out. Keep good records. And you mentioned EU complexities with withholding taxes.
Yes. Income flowing cross-border in the EU often faces withholding tax, WHT, in the source country. Rates vary. Double taxation treaties, DTTs, between countries aim to prevent double taxing, potentially lowering WHT or giving you a credit at home. Claiming DTT benefits usually requires proven tax residency. There are EU efforts like the FASTER directive trying to simplify this, but it's still a work in progress.
So the constant theme is tax is complicated, variable, get professional advice tailored to your situation.
Absolutely. Tax impact is crucial for your real net return. Understand it upfront.
Finally, looking forward, what's the market outlook for real estate crowdfunding? Is this trend expected to continue?
All the sources point towards continued substantial growth. The specific numbers vary wildly. You see projections from different firms mentioning huge CAGRs, like 50–60%, leading to market sizes in the hundreds of billions globally within a few years, or more conservative but still strong growth estimates.
So despite the varying forecasts, the consensus is significant expansion ahead.
Yes. It suggests increasing adoption by both investors looking for alternative and real estate players seeing it as a viable capital source, especially with the regulatory framework solidifying. It's seen as a rapidly growing sector.
Okay, let's try to wrap this deep dive up. Real estate crowdfunding in the U.S., boosted by the JOBS Act and tech, offers this compelling way to access property deals.
Right. Bypassing big capital needs, landlord duties, offering diversification, access to different deals, potential passive income, lower entry points.
It democratizes access, offering debt for income or equity for growth, catering to different profiles.
But it comes with major risks needing serious attention. Illiquidity is chief among them. Your money is likely locked up for years, exit options are limited and unguaranteed.
Plus market risk, platform risk, trusting the intermediary, and the risk of the specific project failing. Complex fees can erode returns too.
Which makes that rigorous due diligence absolutely essential. Know yourself, vet the platform meticulously, analyze the specific deal using frameworks like the 5 Ts. Understand debt versus equity, get tax advice.
It demands active engagement despite the passive label.
Passive income potential doesn't mean passive investing. Far from it.
So maybe the final thought to leave you, the listener, with is this. Considering the lockup, the illiquidity for potentially years, and the trust required in both the platform and the sponsor over that time, often with little recourse.
Does that promise of potentially higher returns and diversification truly outweigh the risks of having capital tied up so long, compared to the flexibility and liquidity of other assets, even if they offer lower yields?
It's a question that forces you to really examine your own risk tolerance, your time horizon, and your willingness to do the necessary homework before diving in.
Requires careful thought. The onus is on you.
We hope this deep dive into U.S. real estate crowdfunding has provided clarity on the mechanics, the potential, and definitely the crucial risks involved.
Thanks for joining us. We'll be back soon with another deep dive.